Hey, my name is Rajesh. I am a direct lender based in Los Angeles who specializes in 2 to 8 unit multifamily buildings. Today we're going to be taking a look at 3731 Glendon Avenue in Los Angeles, California. And it's a 6 unit apartment building for $1.5 million and a 6.02 cap rate. Let's see if this property makes sense and how we can have it make sense. So it was 1.499 million, 6 units, and let's see how many units are occupied here. Does not say, but it does say gross rent multiplier 11.87 GRN. So the way we do that is we divide the purchase price by the gross rent multiplier, or GRM, and that tells us the annual gross rental income. So it says right here 1.26284, and this one says down here $126,337,000. So we'll just use the one that they gave us, 337. That's gross rental income of 10,600. What, 43? Yeah, 43. And 38 cents. Property taxes, landlord insurance, 6 units. So we're actually looking at maybe $6,600 a year or $550 a month. Let's see what we're looking at as far as common areas to figure out what we can assume about utilities for common areas. So I don't know if you can see that over there, but that looks like meters to me right there. And so I would assume that each unit has its own utilities. Trying to get better photos, but this website does not make it easy to get photos sometimes. Here's the offering memorandum. Let's take a look at what that can tell us. So loading. Alright, there we go. It loaded it up. Once rented out, the property will operate at a 7.35 GRN. But didn't it just say right here 11.87 GRN? And it says once rented out, so is it not rented out right now? Financial analysis. Okay, here's the current rents, and here are the market rents. So we're actually looking at, and when we underwrite these buildings, we actually use the lower of the two. So let's say each unit was rented out for $5,000, which is which is almost twice what the market rents are. We would look at the market rents because they're the lesser of the two. We assume when lending money, we like to assume the worst case possible. So if you're the super awesome property manager and you're able to get $5,000 per unit, and that's because you believe you're so awesome, you're right, because you're so awesome. But when we had to foreclose on you and take it over, because we're not as awesome as you, we're only going to be able to get market rents. On the other hand, let's say you've not updated you've not, or rather the owner, the seller has not been keeping rents up with the property, with the market rates, as in this case, what's going to happen is, okay, well, how do we know it's going to take 6 months, maybe 9 months, maybe a year just to evict these tenants, the low-paying tenants, assuming you want to upgrade their units. And in California, you have to follow certain laws. You can't just evict them for the sake of evicting them. You have to evict them because you want to actually move a family member in there, which means zero rents, or you're actually going to upgrade the unit. You're going to do some serious rehab in there to get it up to market rents. So in that case, you're going to have zero rents still coming in while you do the remodel. So that's why we look at the worst case scenario, or the lower of the two right here. And in this case, it's 97.78. So we're going to go to gross rents occupied, 97.98 per month. Now let's see here. Property management fee is 4%, or 5053. 5053 divided by 12 is $421 a month. Taxes, maintenance, $500 per unit, or $3,000 per year. So I actually had it at $500, which is $6,000 per year. Let's see here. $3,000 would be about $250 a month. Let's see what else. Insurance is $32.29, but it's a 6 unit, and when you go to try to get the same policy again, you're just not going to get it. I've had this happen several times where I'm underwriting it based on numbers in the OM, and then when it comes time to actually close and get insurance, it's nowhere near that stated insurance. Water is 6 units, so it looks like it is, wow, no, those are shared utilities, 2,100. So 2,100 divided by 12 is $175 a month. Landscaping is $75 a month. What about trash? Nothing here about trash, so we'll just put that under landscaping. Electric and gas, I don't see anything over here. Utilities paid by tenant, gas and electric. And this says taxes are $17,988, but it says estimated. And I'd prefer to qualify at the higher one, because if it qualifies for a loan at this number, it's going to definitely qualify when the expenses are less. Proposed financing. So $974,000. So let's see here. 974,350 divided by purchase price of 1.499. So they're saying 35% down. 35% down. And your payment at 6% would be about $58.42. We're going to see if we can do better than that. Net operating income, does it have that here? $90,000. Scheduled gross income versus actual monthly income. So they're using the wrong numbers here, I think, because we are using, from their own math, 97.78. 97.78 times 12 is $117,000, not $126,000. They're using a 3% vacancy rate. We're using 0. So the easy way to fix that is 97. So this is a 6 unit. You're going to need at least 30% down. Here's what you got to get with a bank loan. So let's see, 5.875, just to hit a 1.2 ratio, 49% down, just to get a bank loan. And this is with interest only. We go no interest only. We're looking at a down payment of $731, 49% down, and a net cash flow of $900 a month. Now let's see a DSCR loan. You're going to have to go 8.250, 40% down, $600,000 down, and you're losing $1,300 a month. So he's on their example here, they used an interest rate of 6% and a DSCR ratio of 1.29. So let's say 6, 1.29, 1.29, and you're looking at $5,866 a month. Yeah, so I don't know how they're coming up with these numbers here. Because this one's just not going to qualify. 1.2, and this is 1.1. So this is closer to that. You're looking at a 34% down payment here. Let's take it down to 35. $529,000. Your monthly payment is $58.15, $58.42. You're losing $369 a month. So even with their numbers, right? Even with their numbers, best case scenario, you're still losing $369 a month. Total return before taxes. So, I mean, this I'm questioning this gross rent number here. Now I can figure out how to make this work. Let's see, bank loan at 5.875. You're going to have to put 40% down because it is a commercial building just to get the 1.20 DSCR ratio. 5.875. Here you need at least a 1.1 ratio just to be able to buy that interest rate down. Now you're actually looking at a 34% down loan, but you're still losing $442 a month. Let's say you want to cash flow $1,000 a month. So now you have to put down almost $750,000 just to make it work. And that's pretty similar to the bank loan, actually, right here. Your monthly payment's going to be about $4,500 a month just on P&I, and then your cash flow is going to be about $1,000, $1,003 on the DSCR loan, $906 on the bank loan, and that's because your down payment is slightly higher, lower here. You're paying 49% down versus 50%. So I'm not going to say whether this is a good buy or a bad buy, but I am saying to make it cash flow, you're going to have to put at least 50% down. And I'm not talking like a minimal cash flow of $1 or something, like $1,000 a month. If you wanted a cash flow of $1,000 a month, you had to put down 50% or $750,000. And considering all the other properties I've shown on this channel, this is probably one of the, it's one of those properties. Let's see what the real benefit of this property is then. If let's see, Glendon Avenue, Los Angeles, CA 90034. Here's a link to it, and you're getting a $1.5 million, property tax at 1.2%, property management was 4%, down payment 25%, let's just leave it there, and, well, no, let's say 50% like we did, just to make it cash flow $1,000 a month. No rehab loans, nothing. After repair value is going to stay at 1.499. And we're dealing with, how many units was this? 6 units. And let's see what the gross rents are. 778 divided by 8, 1222.25. 1222.25. Did I do that? No, I divided by 8 again. I've got an 8 unit stuck in my head, I guess. No, that did not sound right. That did not sound right. Divided by 6. 1629.67. 1629.67. Alright, there we go. So now we're looking at a DSCR ratio of 1.34. And this is a gross DSCR ratio, not a net DSCR ratio. Now we can sort of go in and punch in actual numbers. So let's see. Legal, they haven't really counted it. I'm going to leave it at 120. Gas was paid by the tenant. Gas and electric are paid by tenant, so 0, 0. And let's see what the water bill is. Water bill we said was $175 a month. Lawn and snow, landscaping $75 a month. HOA and trash removal $0. Pest control is $0. Advertising $0. They haven't included those costs in there. So here's your net operating income. First year, you're looking at about $64,000 a year. Your net cash flow, which I'm surprised at this level, is $64,000, or sorry, $11,000 net cash flow, because your debt service is at $53,202. That's at a 5.875% interest rate. You can, at this DSCR ratio, you can either get a 6.99% interest rate for 0 buy down, or if you're willing to spend like an extra 5 points or 5% of the loan amount, to buy it, so let's see, 1.5, so you're looking at $750,000 loan times 0.05, you're looking at $37,000. Okay, so let's say your choice is between buying it down and not buying it down. 6.99, your DSCR ratio is 1.27, your net operating income stays the same, and your net cash flow is $4,500. Okay, $4,500 a month, 5.875, a little more than a whole percent lower, and your net cash flow is $11,000 a month, right? And this cost you, and it's costing you $37,500. So you've got 11,000 minus 4,500. Now you've got to divide this by 6,500. 37,500 divided by 6,500. So it would take you 5 years, almost 6 years, to recover that that difference in payments, to recover the cost of the buy down and the difference in monthly payments. 6 years. But this loan is going to last 30 years. So it may not be a bad idea to do it, especially if the seller is footing the bill. So let's see what this actually looks like here in terms of an exit. So the exit is $11 million after 30 years. In 5 years, you're only going to gain $200,000 because the first few years you're still stabilizing the place. But your 10th year, it's $1 million exit. Your 20th year, it's a $4 million exit. And this is on top of what you've already spent. So that means you recover everything you've already spent and then some. And that then some in your 10th year is $979,000, almost $1 million. Your 20th year, that's $4.25 million. Your 30th year, that's $12 million. But when you take into account all the cash flow, and here's what I wanted to point out about the cash flow. The total cash flow on this building is actually a loss. Because your very first payment is the down payment, right? So even though that's yours and you're just transferring accounts, it still counts as a cash expenditure. At least on this chart. So that's an expense that you have to deal with. And you see that as a debt service right there. But you can always add that $900,000 back in. But here's the magical thing that happens. Let's say you add that $900,000. You count it as, you just stop counting that as an expense, right? Whoops. I need the calculator. So you take $968,699, and then you get rid of that 900,137.91. You're still losing $68,500 over the lifetime of this property in terms of cash flow, just because the numbers are so dismal. And you can see it more clearly right here in the gross rents area. So your first year is $1,629, and you're adding what? How much are you adding to the rent every year? You're adding 3.18% to the rent every year because that's average for this area. So let's see what that looks like in 30 years. What will the rents be in 30 years? It's going to be about $4,000 a month. And each time your expenses generally stay the same. But your expenses get bigger as well, rather. So your income's going up, but not as much as your expenses. because yearly inflation is at 4.86%. And in California, they have a maximum rental increase of 5% plus inflation or 10% per year, whichever of the two is lower. So those are the ceilings. The actual controller of how much you're going to increase your rents is market rent. Because if you raise your rent 10%, which is the max allowed, right? And everybody else either has the same rent or keeps it lower, you're going to lose tenants to them, period. That's how commoditized the rental market is that there's a lot of competition. And so when one landlord decides to raise rents 10%, 50%, 100%, doubles their rents, right? Well, they still are constrained by the market. And the market's going to say, well, rents are actually going down. And you see this when people are giving 3 months rent. When they say get the first month free or get 1 month free of rents, get the move-in free. And they're trying to attract people because they're having a hard time attracting tenants at current rents. So the idea of landlords just doubling rents randomly and still making money, that's just not going to happen. But even with the loss, if you look at this, the lifetime loss of cash flow here, whether you're thinking it's $968,000 or only $68,000, at the end of it all, you're still walking away with $11 million. And this might actually be closer to $12 million if you count that original $900,000 of debt service as not being debt service, but rather just an equity down payment. And let's see where that $900,000 came from. You're going to see it here as in debt service as an expense, $749,000 plus $50,000 in closing costs, plus $45,000 in realtor commissions, assuming that the buyer has to pay the buyer's agent. So you're looking at a total of $850,000 your very first year. And then you got also 12 months of monthly payments, which at $4,400 a month is about $50,000. So you add this up with this, your initial closing costs and everything, and then you add in the actual debt service, you're looking at about $900,000 right there. And so that's where this $900,000 comes to over here in the debt service. And you're wondering, where's that extra $18,000 come from? Well, on day one, your net operating income is already minus $18,000. Just because you still got to pay all of this, even though you haven't collected anything in rents. So we had to account for that. But that's still a 1,300% cash on cash return. That means for the initial $900,000 you spent, you're getting back about $11 million, which is not a bad deal. It's just going to take 30 years to pay itself off. And if you've got the ability to do so, you may choose to.